Okay, so now let's get into the Schedule J, which is the accumulated E&P of the controlled foreign corporation. So just a quick note here, or a warning I should say. Schedule J is, quite frankly, the most complicated schedule within the Form 5471 series, right? So of all the schedules you look at, I mean, maybe Schedule E with the taxes being paid, foreign taxes paid, can be quite complex as well. But I think Schedule J can be either very straightforward and kind of simple, depending on the fact pattern, or it can just be an absolute nightmare. And as we get into the video here and I explain some of these columns and the rows and all the different rules for allocating distributions, you'll quickly see why that can be, right? So you can have CFCs with a mix of U.S. and non-U.S. shareholders, different types of income flowing through, so different types of Subpart F income. We could have Section 965 transition tax income. We could have investments in U.S. property. A lot of different types of income, and everything needs to be separately categorized in its own bucket. So it just makes it very, very complex. So if in going through this video and looking at your own Schedule J's, you find it quite complicated and frustrating, you're not alone. So it's okay to feel that way. This thing can be quite the bear to complete. So Schedule J, again, who needs to complete this? Well, if we go back to our schedule here, or table rather, on the required information, category filer, we can see here a separate Schedule J is required for the CFC if you have a Cat 1A filer or 4 or 5A. In our case here, we're category 4, 5A, and we're 1A. So yeah, we're doing the Schedule J. We can't avoid it. Now, if we go back to the Schedule J here, a bit of background on kind of how the format works here, and also a quick reference to Schedule P as well, which will be the next video. So Schedule J, we want to think of this as kind of the corporate level accounting for previously taxed earnings and profits, or PTEP for short, so PTEP. So Schedule J, what we want to do is reconcile as a whole all the earnings and profits of the corporation, how they're being reallocated to all these PTEP categories, and then how we are tracking the distributions out of the foreign corporation to both the U.S. shareholders and the non-U.S. shareholders. So it's kind of a high-level look at everything, but also a ton of detail. Now, in contrast, if we look at Schedule P really quickly, which will be the next video, this schedule kind of does the same thing, but it's on an individual shareholder basis. So John Q. Taxpayer here, he's the filer, but this Schedule P specifically is for John Q. Taxpayer as the U.S. shareholder. So when we have our allocations of PTEP and then we have our distributions being allocated to PTEP and non-PTEP, this is going to be on a shareholder by shareholder basis. So in our example, because we have only one U.S. shareholder, the numbers are going to match up, right? They're going to be the same because we've only got one person. But in cases where you have multiple U.S. shareholders and then you have some other foreign shareholders in there, it's likely that they won't match up. What you'll see is perhaps all the consolidated PTEP, or sorry, not PTEP, Schedule Ps will line up with what we have on Schedule J. Now, how does Schedule J work? Well, there's two parts, and it's a 3-page form. So we have Part 1, which covers the accumulated E&P of the CFC. So Part 1 spans page 1 and then page 2. And then we have Part 2 here, which covers non-previously taxed E&P subject to recapture. Okay, so the Part 1 has line items 1A through 14, and it moves across left to right across all of these columns and extends onto the second page. So in other words, what I mean here is we have line items 1A through 14, columns A, B, C, D, and E is broken down into a number of sub-columns, right? So we have E1, E2, and then it extends onto this page, right? So we still have the same line items, the rows, or sorry, not the rows, the same number of, same number of rows, 1A through 14, but it extends across all these additional columns too. So 3, 4, 5, 6, and so on, and then it gets down here, same row 1A to row 14, for column E8, E9, E10, and then column F, right? So think of it like if you were to put this page up to the right here and just read everything left to right. Obviously, they couldn't do that because it wouldn't fit on one sheet. It'd be a very long page. So that's important to remember because it can be kind of confusing when you're reading or entering adjustments left to right, and then you get down here and this all kind of looks like a mess. Okay. So where to start? When you have the Schedule J, in order to complete this, you're going to need to already have completed a number of schedules, which we talked about in the previous videos. So the first one you'll certainly need is Schedule H, right? So the current E&P of the corporation, you need to know that amount, right? So we need to know the current E&P, and you should have also completed Schedule I for all the U.S. shareholders. So Schedule I, again, this is the summary of basically the income inclusions, right? So the Subpart F income, the 951, A1A income inclusions for each U.S. shareholder, right? That because John's the only U.S. shareholder, this is going to be the total income inclusion for him, and it'll be the only income inclusion for the entire foreign corporation as a whole, right? Because again, he's the only U.S. shareholder. So you're going to need all the Schedule I's if there's multiple U.S. shareholders. You'll need the Schedule H for the current E&P, and you'll also need to know the amount of dividends distributed to the shareholders, and specifically you'll need to know the distributions during the year, right? And you'll also need to know, are they being allocated to the U.S. shareholders or non-U.S., right? And that's very important because when we talk about allocating distributions to PTEP, the portions of the dividends that are being paid to non-U.S. shareholders shouldn't be applied to PTEP balances, right? Because the foreign corporation E&P allocated to foreign persons, foreign shareholders, is going to be non-PTEP, so non-previously taxed income. All right, so because this is a first-year corporation, first-year Schedule J, you notice here 1A, balance at the beginning of the year, this is going to be 0 across all the columns, right? So column A through F, right? So A, B, C, and D, all the E's, right? So columns E, all of these are blank at the top, 1A, and then column F, and the total is going to be blank as well. Now, obviously, if you're filling out this for a corporation that is beyond 1 year of existence, they very likely might have some beginning balances for these various columns, right? And so what you would do is look at Schedule J for the prior year, roll forward those numbers to the beginning balance, depending on whatever column they correspond to, okay? Now, very important here, just to note, line 1B, notice here it says beginning balance adjustments. So beginning balance adjustments, if you have a mistake that was made in the prior year, do not make the correction directly in line 1A. In other words, don't delete the rollover number and put in the correct one. The IRS wants to be able to trace a rollover of the prior numbers to this current year, and then if there's a change that does have to be made, you can make that adjustment either up or down on line 1B, and then you get your adjusted net balance on line 1C. Okay, it's consistent with kind of what we see in a lot of other tax forms and reporting. Always roll forward the prior year numbers, right? Whether it's, let's say, your balance sheet figures, roll those forward, and then have adjustments made during the current year to be able to get to a correct beginning balance number. But don't just force a new number in column 1A. So when we talk about foreign corporation E&P and PTEP, there's basically 3 buckets, right? So we have section 959 C3 E&P, right? So that's here in column A. We have 959 C2 E&P and then 959 C1 E&P. Now 959 C3 E&P, think of this balance. This is the non-previously taxed income balance. And as a starting point, this is the foreign corporation's E&P at the beginning, right? So that's our E&P, 23,676. That's what we see on Schedule H. And that is our starting point for the overall E&P of the company. Now, what we do with that as a starting point, then we reclass certain portions of the E&P that need to be included as PTEP, right? So the whole point of this is we have U.S. shareholders that need to have that income passed through to them as Subpart F income, right? And so what we're doing is we're saying, okay, this might be the total, but how much of this needs to be moved into some type of PTEP category that is going to flow up to the U.S. shareholder, and then they're going to record it as income and pay tax on it. Now you can see here in columns B, C, and D, these are all blank at the start and throughout the schedule. So column B is post, as you can see here, it's labeled post 1986 undistributed earnings and pre-2018. So if you have a new CFC, obviously this would be blank because the company didn't exist, before, let's say 2021 or 2018, whatever it might be. So this is going to be a roll forward for these older CFCs that might have something in that beginning of year balance. Now, what's the significance of pre-2018? It's the TCJA, right? So the Tax Cuts and Jobs Act that was passed during the Trump administration made a lot of changes. They added GILTI, they added FDII, they made other changes to Subpart F, and so that's why we have to track separately these post-86 or pre-2018 earnings. And then in column C here, we can see, pre-1987 E&P, that's PTI, right? So, or not PTI for that matter. So again, 959C3 balances. Okay, and then column D, beyond the scope of this exercise, but if you have any kind of hovering deficits, then those would be tracked separately in their own column, right? So this is all really 959C3 balances, but again, I mean, in the effort to make everything kind of easier to track, you do need to track these separate buckets if you do have a CFC that's been around for quite a while. Now, column E is where the real fun starts. So column E includes all of these subcolumns, right? So this is where we have the PTEP. So anytime we're making a reclassification, right? So 959C3, and we're having an inclusion in that U.S. shareholders' income. So we're moving it from 959C3 to one of these. You're going to have amounts end up somewhere in here, right? So 965, that's the transition tax. That falls within column E. We have 959C1 PTEP, so this is earnings invested in U.S. property, and it goes on and on down the list, right? So 951 Cap A, that's the GILTI inclusion, and then at the very end here, 951 A1 Cap A PTEP, this is where we're going to be working, right? So 951 A1 capital A is for those Subpart F inclusions, right? So remember, we have foreign personal holding company income, right? That's what we're working with up here for John Q taxpayer, right? So 954C Subpart F, foreign personal holding company income. So this is 951 A1 income, and it is going to be included under section 959C2. Okay, so how do we do that? Well, once we've got that entered there, the reclass is a negative adjustment and then a positive entry in one of the other lines, right? So mathematically, I mean, it seems obvious, but again, it takes a while. You might have to stare at this while to really make sense of it. But what we're doing here is we're backing out the $17,757, right? Because that's the amount of income that's going to be included in the U.S. shareholders' income, right? That's the inclusion under 951. And so what we do is we have a negative adjustment, 9 of 17, 757, and then on the same line item, right? So line 8, we go all the way across here, move it, line 8, all the way here, 17,757. So what we've done is we have reclassified section 959C3 PTEP to 959C2 PTEP, which is this bucket here. So section 951 A1A, that is, again, that's the Subpart F inclusion that's going to be part of John's tax return. And so notice here in column F, it's zeroed out, right? Because we have a negative 17 and now we have a positive, so we have a zero reconciliation here in column F, and that's what we want. Now, the reason why this can get quite messy is because you can see here how we could have situations where you have E&P here at a starting point, and then you have reclasses coming out that are hitting multiple columns, right? So you could have reclasses moving from C3 to C2 E&P across all of these different columns in column E. It really just depends on, how big is the CFC, how complex are their operations, right? A lot of these are big, like private equity or hedge funds, and so they have a lot of different types of income streams running through it. Particularly if it was a company that's around that had Section 965 transition tax. It's got Subpart F income. It's got GILTI income, 951 Cap A. So that's why when I say this can be a complete nightmare of a form. Those are scenarios where that happens. In our situation here, we have purposefully created a fact pattern here that's not too, cumbersome to kind of learn and be able to follow, right? We have simple E&P here. We have one U.S. shareholder that's being allocated 75% of this E&P. That allocation is all Subpart F income, so that's his inclusion. This comes out. It gets reallocated to the 951 A1A bucket, and that's the end of it, right? Now, let's talk a little bit about the cash distributions that would apply. Now, why is it so important to track the cash distributions or dividend distributions that are coming out of the CFC? Well, it's because we want to try to prevent and, frankly, eliminate any kind of double taxation that might occur. So how could that possibly happen? Well, if we look at John up here, right, this is what income John is going to have to include on his tax return. Now, because this is Subpart F income, he has to report this income whether he gets $1 in dividend distributions or not, right? It's basically treated as pass-through. So if John reports this as income and then in the same year or a later year he gets a dividend distribution, what he does not want to have happen is have to record income tax on that actual cash dividend distribution, because he would effectively be paying tax twice, right? He's paying tax here, and if in the next year he gets a $17,000 dividend, and the IRS says, "Hey, look, we see a cash dividend hitting your bank account." It's like, no. I don't have to pay tax on that because I already included the income in the prior year. And that is what is so important about Schedule J, is because we want to be very careful about tracking, okay, what is PTEP? So what's actually been recorded as income and paid tax on already by the U.S. shareholder? And then how are we allocating the actual cash distributions that come out as dividends to those various amounts? So if we remember the dividend distributions paid out to the shareholders. So E&P was $23,676, right? Let me go to our financial statements here. So E&P was $23,676. That was the earnings for the company. And then they made a dividend distribution of $5,000, right? So 75% went to John, the U.S. shareholder, and then the remaining 25% went to that Bermuda company that has a foreign owner. So that is not a U.S. person for purposes of the CFC rules. Now, when dividend distributions are made by the CFC to the U.S. person, there are certain ordering rules that apply with respect to how you apply it to PTEP and non-PTEP income. So in John's case, he received a dividend distribution of $3,750, I think it was. Yeah, $3,750 was the amount of dividend distribution, so the cash he actually got during the year, right? So now the question is, how do we allocate that distribution to PTEP and non-PTEP income? Well, under the ordering rules, if you have a dividend distribution to the shareholder, under Section 959C, right, the ordering first requires that the distribution is first allocated to 959C1 type of PTEP, and then it gets allocated to C2 type of PTEP, and then lastly C3 PTEP. So basically, what we're trying to do here is saying if we have multiple types of income, right? So if we have a lot of different types of income in here that span C1, C2, and then ultimately, remember, this column is C3 income, we have to apply the ordering rules to knock out the balances first before we move on to the next one. That's kind of high level how it works. Now, in this example, it's pretty straightforward because we only have one type of income, right? So we have 959C2 E&P here, right, from the Subpart F income inclusion. And so when John receives that dividend distribution of $3,750, we can apply the whole thing to this balance. Where it would get a little trickier is if he had perhaps a dividend more than this, or if he had other types of income that were flowing through here, then we would have to more carefully look at how are we applying this $3,750 as a reduction to these various balances. But in our case here, we just know that, okay, there's only one type, and so we're applying it there, and then we can move on, right? So no issues there. Now, the remaining dividend distribution that went to the foreign shareholder, right, so the non-U.S. shareholder, that amount can simply be reported here in 959C3, right? So this is a reduction of E&P for the company, certainly is, right? I mean, if we look at the balance sheet again, right, dividend distributions reduce the E&P for the corporation, but because that portion was paid to a non-U.S. shareholder, it's not a reduction in PTEP. So it wouldn't come out of any of these balances here because, again, these types of PTEP, this is really only impacting U.S. shareholders, right? And so the dividend distribution payments to those foreign shareholders can simply be added here, or, I mean, it's a reduction, but their portion is reported here on line 9, column A. So when we look at the bottom here, we've got our ending balances that are going to carry forward next year. The total E&P for the corporation, a quick check here, remember E&P is, or ending E&P rather, is the additions for the year, so the total earnings and profits reduced by any dividend distributions. So our E&P is $23,676. If we subtract out the $5,000 in dividend distributions, our ending E&P is $18,676, right? So if I just do like let me do a little math there as a check so you can see that. Right, so $18,676, that's our ending E&P balance for the foreign corporation as a whole. And so if we look here at the ending balances, we can see our ending balance of 959C3 is $4,669. Our ending E&P balance for the 959C2 E&P, right, which is this 951A1A inclusion, $14,007. And then the total matches, right? So $18,676 is the ending E&P balance for the foreign corporation. Now, if we pause for a moment here and think about what this means for the next year and why this is significant, this is the ending balance of previously taxed earnings and profits that was allocated to that shareholder, John. So what this means is, let's assume for the next year the company didn't earn any money, so no E&P additions, and John were to receive a dividend distribution from the company. The dividend distribution, again, we would want to be applying it against this balance first because he's already paid taxes on the income because he had an income inclusion in the prior year. So we always want to be tracking very carefully what's this PTEP balance. Again, we're tracking this at the corporate level. This is the corporate level accounting. We'll look at Schedule P for John later. But we want to be very careful about tracking what are the PTEP balances across all of these different buckets because we do not want to be burdening the U.S. shareholders with basically paying double taxation. We don't want them to be recording dividend distributions as income if they've already recorded the income and paid tax on it in the prior year. Okay, so that, again, is high level what we're trying to accomplish with this form. Okay, so now let's talk about Schedule J, Part 2 here. Very brief, but very important to remember to complete. So Part 2, again, is non-previously taxed E&P subject to recapture as Subpart F. And so we can see here we've got $8,659. So where do we come up with that number? So the $8,659 is the excess of E&P over, to the excess of Subpart F income over the E&P. Remember, when we looked at our earnings and profits limitation, let me find the schedule really quick here. Okay, so remember when we did this worksheet in prior videos, what we were doing was we were calculating the gross amount of Subpart F income, right? And then we were calculating the E&P, right, sorry, slow down there, probably going too fast. Okay, so remember this worksheet, we were calculating the gross amount of Subpart F income that would be included in the shareholder's income. But one of the tenets or the rules of Subpart F inclusions is you cannot have a Subpart F inclusion in excess of your E&P. Right, and remember, our E&P is about $23,000 and change, $23,676. We can see here that our Subpart F income is $32,335. The Subpart F income, and then the limitation down here. Remember this at the bottom. We have our current E&P limitation, $23,676. That's our total Subpart F income. So our Subpart F income inclusion is going to be limited to $23,676, right? Now, all that extra Subpart F income, it doesn't disappear forever, right? It's potentially subject to recapture if you have extra earnings and profits in future tax years, right? So we have our $23,676 limitation. This is the limitation on what's Subpart F income for the current period. But if you take the amount of Subpart F income, so that $32,335 number, and then you subtract the amount of Subpart F income that's actually allowed for the year, so $23,676. Let me pull up a quick calculator here so we can actually do the math. So $32,335 minus $23,676. We can see we have a difference of $8,659, right? That is the extra Subpart F income that is potentially subject to recapture, right? And so that is what's being reported here on Schedule J, right? So the additions to non-PTEP subject to recapture, $8,659. So it's important to track that balance year to year. Because if you do have, again, if you have enough E&P in a future period to be able to recognize that additional income, then you have to do it. So that's where we get that number there. Remember, that number, again, it's the gross Subpart F income over what was actually recorded for the year because of the E&P limitation. Okay, so that covers it for Schedule J. I know it was a lot. I hope that was relatively easy to follow. Again, I'm going to have more complex tutorials on Schedule J, which you're going to see a lot more numbers here, so perhaps it'll be better when if you want to learn some more of the complex topics. But for purposes of this example, we have a relatively straightforward Schedule J for our CFC. So, all right, so that covers it for this video. Now we're going to move on to the Schedule P for the individual shareholders reconciliation of PTEP.